Hey everyone, welcome back to Corporate Decoder, where we break down the dense language of corporate finance and spill the tea. And today we're diving into AmeriServ Financial's report, an exciting look at how they've been doing. Get ready, folks, because this report has some twists and turns that might surprise you if you're into understanding where your money's going and how companies tick. Make sure you subscribe and, hey, join our Discord community to chat about these findings and get even more insights. Alright, let's get straight to the juicy stuff. AmeriServ Financial's financial performance. This filing gives us the inside scoop on how they're doing, especially looking at their balance sheet and income statements for the period ending in June of 2025. On their balance sheet for that June period, we see total assets sitting at a hefty $1.4 billion. Now, what's really interesting is their loan portfolio. Net loans after setting aside money for potential losses are just over $1 billion. That's a big chunk of their business. Now, let's talk about their profits, or in this quarter, a slight loss. For the 3 months ending in June 2025, they reported a net loss of $282,000. That's not a huge amount for a company this size, but it's a change from the modest profit they made earlier in the year. This loss seems largely tied to a specific large loan that needed a significant write-down, as noted in their provision for credit losses, which jumped considerably. Looking at comprehensive income, which includes things like unrealized gains or losses on investments, they reported a small gain here for the quarter, around $657,000. This is mainly due to changes in the value of their investments, which can swing back and forth. When we check out their cash flow statement for the first 6 months, it tells a story of increased investment. They used more cash in investing activities, largely because of buying more investment securities. This is a sign they're putting money to work, expecting it to generate returns. Financing activities show a healthy increase in deposits, which is a crucial source of cash for banks. Let's talk about their investments. Their available for sale securities have a cost basis of over $183 million. What's particularly noteworthy is how many of these are in unrealized loss position. That's when the market value has dropped below what they paid for them. For instance, at June 30, 2025, they had over $13 million in unrealized losses on securities held for less than a year, and a much larger amount, over $102 million in unrealized losses on securities held for less than a year, and a much larger amount, over $102 million in losses on securities held for less than a year, and a much larger amount, over $10 million in unrealized losses on securities held for less than a year, and a much larger amount, over $102 million in losses on securities held for a year or longer. They state these losses are mainly due to market interest rate changes. In response to these unrealized losses on some investments, they've increased their allowance for credit losses on these available for sale securities. It went from $360,000 at the end of last year to over $1 million by June 2025. This shows they're being cautious about potential future losses on these investments. Back to their loans, net of the allowance for losses, they are just over $1 billion. This is their main business driver. They've broken down their loans by type, like commercial real estate and residential mortgages. Their commercial real estate portfolio, especially non-owner occupied loans, makes up a big chunk of their lending. Looking at the quality of their loans is super important. They use an internal rating system, and a part of their loan book, about $21 million in total, is classified as substandard or doubtful. This is a concern, and it's a key area where they might face future losses. Their non-performing loans as a percentage of total loans have increased. At June 30, 2025, it was 1.42%, up from 1.02% at the end of last year. This rise is mostly tied to a few commercial loans being moved into non-accrual status, meaning they're not earning interest anymore. Now, AmeriServ has a significant focus on commercial real estate, and regulators are paying close attention to this sector. They've noted that their non-owner occupied commercial real estate loans represent over 51% of their total loans. This concentration in commercial real estate, especially with some of those loans being flagged as higher risk, is definitely something to watch. They're also using derivatives, mainly interest rate swaps, to manage risk. These are complex financial tools used to protect against interest rate ups and downs. For example, they've hedged about $70 million related to deposits. The effectiveness of these hedges can impact their overall financial picture. Looking at their pension plans, they actually reported a net benefit for the period. This is mostly due to employees choosing to take lump sum payments, which reduces the company's future pension obligations and costs. It's always good to see when a company can reduce its long-term liabilities. Shareholders' equity has increased to over $110 million. Tangible book value per share, which is a more conservative measure of value, also saw an increase to nearly $5.90. Its internal value. Now let's put on our Warren Buffett hat and look at the big picture. AmeriServ Financial is navigating a tricky financial environment. Their net interest margin is actually improving, which is a strong sign of effective balance sheet management. They're attracting more deposits and seem to be managing their borrowing costs well, especially with the Federal Reserve's rate adjustments. The increase in their loan portfolio, particularly in commercial real estate, is a double-edged sword. It drives revenue but also brings higher risk, especially given current market concerns about that sector. The rise in non-performing loans and the significant jump in their provision for credit losses for loans in the second quarter really highlights this risk. They're managing it, but it's a strain. The positive movement in shareholder equity is encouraging, and the benefit from pension plan changes is a nice bonus. However, the large unrealized losses on their investment portfolio are a concern, indicating potential future volatility if those securities are sold. Overall, AmeriServ seems to be strategically managing its core banking operations, especially in growing its deposit base and navigating interest rate changes. The key weakness here is the concentration and performance of its commercial real estate loan book and the management of investment securities. In a fluctuating market, a notable opportunity lies in continuing to leverage their core deposit strength while carefully managing credit risk in their loan portfolio. They're showing resilience in their net interest income, but the credit loss provisions are a clear warning sign. What's your take on AmeriServ's financial health and their strategy going forward? Let me know your thoughts in the comments below. If you found this deep dive valuable, give this video a thumbs up and don't forget to subscribe for more corporate breakdowns. And seriously, join our Discord community, linked in the description for more direct chats and insights. Thanks for watching. See you next time.